Hi, everyone, and welcome to today's virtual conference on the Federal Reserve's response to the coronavirus pandemic and its outlook for the future. We're delighted to have our speakers with us today, as well as everyone joining us in the audience. Before I turn it over to the speakers, just a couple quick housekeeping notes from me. We will reserve some time at the end for our audience Q&A. We ask that you please submit those questions throughout the discussion by using the questions pane in the control panel, and that should be located in the upper right-hand corner of your computer screen. Send those in at any time, we'll collect them, and then when it's time for Q&A, we'll select individuals to call on, and we'll briefly unmute your lines so that you can pose your questions directly to the speakers. We do ask that the press who's on the line today, please refrain from submitting questions. We do want to reserve the Q&A portion for our Bretton Woods committee members and friends. So with that, I'd like to just briefly introduce our moderator today before turning it over to him. Mr. Bill Dudley was the president and CEO of the Federal Reserve Bank of New York from 2009 to 2018 when he retired. And since then, he's been involved in many things, among them our very own Bretton Woods committee. And he's been really instrumental in spearheading a really exciting renewal for our organization, assembling a new and larger leadership team and a new strategic direction. And we'll be excited to announce more about that in October. But I just want to thank Bill for his time and energy and leadership over the past several months. You've certainly been very helpful, and the organization's in great hands under your leadership. So Bill, over to you.
Well, thank you, Emily, and thank you for being such a great executive director of the Bretton Woods Committee. So it's a great pleasure for me to be able to participate today in this event with John Williams, the president and CEO of the Federal Reserve Bank of New York. I've known John as a colleague and friend for many years, and I greatly respect his judgment, expertise, and commitment to public service. As president of the New York Fed, John's also vice chairman of the Federal Open Market Committee. And he also sits on the board of directors of the Bank for International Settlements and participates in the bi-monthly meetings the BIS has with central bankers from around the world. The New York Fed has a special position at the BIS for several reasons, including the fact that the Federal Reserve implements U.S. monetary policy on behalf of the Federal Reserve System, and the fact that the New York Fed runs the international banking operations of the Federal Reserve System, including its foreign exchange swap operations. Prior to becoming president of the New York Fed, John was the president of the Federal Reserve Bank of San Francisco. And he also headed the research department there, starting his career as an economist at the Board of Governors. During his career, John has published many seminal articles on economics and monetary policy. He's probably best known, at least recently, for his research on R-star, the neutral inflation-adjusted interest rate. The downward drift in R-star is really one important reason for the changes that Chair Powell announced last week in terms of the Fed's long-term monetary policy framework. So without further ado, let me turn the floor over to John for some brief remarks, and after that, we'll begin our conversation. John, the virtual floor is yours.
Well, thanks, Bill. It's great to be with you today, even if virtually, and I'm very much looking forward to our discussion. But before we dive in, I thought I would offer some thoughts on the announcement made last week about the completion of the Federal Open Market Committee's review of our monetary policy framework and the issuance of a new statement on longer-run goals and monetary policy strategy. Now, before I continue, and Bill, I guess I could have you do this part. You've done it so many times in the past. I will give the usual Fed disclaimer that the views expressed are mine alone and not necessarily those of the Federal Open Market Committee or anyone else in the Federal Reserve System. And I'm going to add one more before caveat, and that is before I explain the new statement, I think it is important to reflect on the context in which the original framework statement was issued. Then I'll share how the monetary policy framework of today positions us best to achieve our goals and manage the very challenging environment that lies ahead. So the original consensus statement was issued back in January 2012 and represented an important step in the committee's progress towards greater transparency around its goals and its strategy. It incorporated key aspects of flexible inflation targeting, a monetary policy framework that gained wide acceptance around the world. And this framework served us well, but the need for change was clear. In the past 8 years, basic facts that shaped the original framework have fundamentally changed. First and foremost, as you mentioned, is the dramatic decline in the neutral interest rate. That is the short-term interest rate expected to prevail when the economy is operating at its full potential and inflation as longer-run goal. Since January of 2012, FOMC participants' median estimate of this neutral nominal rate has fallen by 1.75 percentage points, from 4.25% to 2.5%. And a similar decline is seen in private sector forecasts and bond yields. The secular decline in interest rates is not only limited to the United States, we're seeing it across the globe, and it reflects longer run trends in demographics, productivity, and other factors that are unlikely to reverse anytime soon. Lower neutral rates constrain the ability of monetary policy to offset negative shocks to the economy, and this effect has been seen most clearly in the behavior of inflation. Over the past decade, inflation in the United States has been below our 2% longer run target most of the time, and measures of inflation expectations have drifted down. And these declines in trend inflation and inflation expectations can create a pernicious feedback loop of reduced policy space and even lower inflation expectations. Again, this experience is not unique to the United States, indicating that it stems from factors common across countries, rather than issues unique to our economy. Indeed, most inflation targeting advanced economies have struggled to achieve their inflation goals on a sustained basis over the past decade. So that brings us to last week's announcement and the issuance of a new consensus statement of our policy framework. It's a culmination of extensive outreach and conversations with communities and stakeholders across the country, very careful and thorough analysis, and active discussion and debate among committee participants. We took important lessons from the experience of the past decade. We reassessed the evidence and looked at the challenges ahead of us. All this effort was worth it. This new statement means we are better positioned to achieve our goals. In fact, the process worked so well that we've committed to repeating it roughly every 5 years. The new framework statement directly and effectively addresses these problems caused by a low neutral rate and persistently low inflation. First, it stipulates that following periods when inflation has been running persistently below the 2% target, a temporary overshooting of this longer run inflation goal will likely be desirable to keep inflation and inflation expectations centered on 2%. Second, it makes clear that we seek inflation that averages 2% over time, consistent with our longer run target. Finally, the statement makes unequivocally clear that we seek maximum employment and will aim to eliminate shortfalls from this broad and inclusive goal. These changes are mutually reinforcing and will meaningfully improve our ability to achieve both of our dual mandate goals in an environment of a very low neutral rate. I'll conclude with this. This new framework represents both an important evolution in our thinking about how to achieve our goals and another step towards greater transparency. It reaffirms key aspects of the original statement that have stood the test of time, refines others in line with experience and evolving practices, and also makes some more significant changes in light of developments and lessons learned in recent years. And most importantly, it positions us for success in achieving our maximum employment and price stability goals in the future. Thanks.
Thank you, John, for those remarks. I think that does a great job explaining the motivations behind the changes in the Fed's inflation and employment objectives. So my first question is going to follow up on those remarks. So given the changes in the long-term monetary policy framework, what do you think this means for the actual conduct of U.S. monetary policy? Does it mean the Federal Reserve will be slower to tighten? And does it mean when the Fed begins to tighten, it will need to do more to restrain economic activity? How do you see this translating to actual monetary policy?
Sure, and of course, how it translates into actual monetary policy depends on the circumstances and the situation we face. This is really a statement of our strategy. We're very careful not to get into the specific tactics or any kind of indication about what we would do in any particular situation. So I do think that a couple things are important to reiterate. One is that I do think that the new framework statement puts on paper some of the evolving practices that we've actually been doing for a number of years. As we saw in the last few years before the pandemic, unemployment kept coming down. The employment to population ratio rose. The labor market got stronger and stronger. Yet we didn't see inflation, kind of inflationary pressures emerge. In fact, inflation generally was slightly below our target. And so we learned a couple things from that says that you don't need to be as preemptive, worrying about inflation is about to take off when the labor market gets stronger. Often this is described that the Phillips curve is flatter than it used to be, but also that the U.S. economy can not only handle a lower unemployment rate and a stronger labor market without creating inflation, but that's obviously told us that the normal or natural rate of unemployment is much lower than we previously thought. So one of the things you'll notice in the framework statement is we really are emphasizing that we're not tied to a particular view of a natural rate of unemployment or a specific number, but looking at a broad set of indicators around the labor market, and again focused on shortfalls rather than the previous language of deviations. I think the other big change in terms of how we'll talk about and think about monetary policy is that we're being clear that moderate overshoots of that 2% longer roll goal are actually desirable in order to get this average 2% inflation rate that we're looking for. In the past, as you recall, a lot of commentators thought that 2% goal was a ceiling, and we tried to convince people with our symmetric language that no, we want 2% on average. In a way, here we're just saying it right there on paper. We want 2% on average. Sometimes inflation will be below the goal, like today. Other times we'll seek to have it moderately above for a time.
Sounds like it'd be a little bit more patient and let the labor market tell you when the labor market's too tight, and you'll use inflation as a sort of indicator of that. Some point out that the Fed has been having trouble achieving its 2% inflation target in recent years. So if you believe that that's true, which I think it's a fair point, and how credible is the shift to a 2% average inflation target? After all, if you can't achieve 2%, why are you going to be able to achieve 2% on average? So isn't it going to be hard to actually get inflation up to achieve this new objective? And so if that's the case, then how important are these changes for the actual conduct of U.S. monetary policy?
So I do think that these changes will actually make it somewhat easier to achieve the goals. They're not easy at any time. But again, going back to say several years ago, where people in the economy might have thought that our goal was, inflation no higher than 2%, and that maybe a little bit below 2% was acceptable. We're making it clear, both in terms of our words and presumably with our actions, that we are comfortable with inflation being moderately above for a time, that we're going to aim to keep that inflation at 2%. So I think it does have implications about how people understand what we're trying to accomplish. Obviously will affect our decisions. And I will just say that, we were at 2% briefly. We were able to get inflation back there. I think the challenge, though, was to, get that sustained 2% average inflation. And we saw some slippage of inflation expectations over the past few years. And we want to make sure inflation expectations, basically people's understanding of what we're trying to get to is well anchored right at 2%.
Yeah, it seems like that's a very primary goal, is to keep inflation expectations well anchored so that monetary policy doesn't get unintentionally tightened as inflation expectations decline. The Fed acted very aggressively and quickly to limit the damage caused by the pandemic and to stabilize financial markets. So if you compare and contrast what the Fed did this time to what we did in 2008, 2009, I think it's fair to say that the response was faster, broader, and of greater magnitude. So how would you explain why the Fed did so much more quickly than last time?
Well, first of all, I think a couple of things are important to remember. One is it's a very different situation. Back then, it was a financial crisis reflecting weakness in the financial system related to the housing crash and mortgage finance. So it's a very different situation today. We're dealing with a global pandemic. And importantly, the banking system is actually a source of strength at this time. The various changes in regulations, the stress test, the requirements around capital and liquidity especially for the banking system in the US and abroad really helped us this time, because the worries around the economy were not about the ability for credit to flow, but really about the effects on the pandemic on people's health and on economic activity. So those are, I think, fundamentally different factors than they were back in 08 and 09. We obviously learned a lot from the experience of 08 and 09, and one of the lessons from then was to move aggressively, move quickly, and provide enormous amounts of liquidity and assurance that liquidity was there to support the flow of credit, not only in the United States, but globally. So I think that, all those factors, led to a very quick diagnosis of what the problem was in March, which was fundamentally a shortfall of liquidity. in the key financial markets, a recognition that we had the right tools to address that in terms of open market purchases of treasuries, mortgage-backed securities, some of the emergency programs around the 13.3 facilities to provide support flow of credit, the swap lines that we expanded and conducted with other central banks around the world, basically acting very quickly, aggressively to solve this liquidity crunch. That worked within a matter of weeks, which was, I think, successful because, again, I think that was exactly the issue we're dealing with this time, and able to bring that to bear very quickly. And obviously, working closely with our counterparts around the world, sharing that information, understanding, and working well together in addressing those issues in those early days.
You're pretty happy with how the response went. You said that the banking system was, a source of strength. How about the non-bank financial sector? Do you feel like there's more work to do there from a regulatory and financial stability perspective?
Well, yes, and I think for two reasons. One is we've seen, a trend movement away from the traditional commercial banking system to the non-bank financial system. We used to call it shadow banking, and we've seen that grow. That's regulated far less than the banking system, and not regulated in terms of financial stability and prudential concerns in the same way. So clearly those trends have accelerated, and I think actually very much like 08 and 09 have revealed risks of runs and panic in those segments. And so I think that's a topic that people will need to look at very closely and understand better what's the appropriate kind of response to that. So right now I'm pretty much focused on dealing with the here and now, but those are definitely issues that people will need to be thinking about.
No, I mean, I think the interventions were appropriate, but you must feel a little uncomfortable about the fact that the interventions were in fact necessary in some sense.
Well, in some ways, if you think about some of the lessons from the earlier crisis, so the money market mutual funds, we and others had recognized that was a systemic risk about runs in money market funds, especially prime money market funds. Obviously, there were changes in regulations around that I think did improve the situation measurably, but still we saw that was a segment that once again was prone to runs and again risks more systemic risks to the U.S. and global financial system. So those are one of those areas where I think we still see those risks were still there, and they manifested themselves in those early days. I think in the broader context, I actually when I think about our liquidity kind of measures starting back in March. I mean, I do think this is what central banks were created for. A lot of times we talk about the Fed, we think about monetary policy, interest rates and things. But I think most people in this conversation know, the Federal Reserve and other central banks were really created, because of financial stability kind of goals and concerns. And you go back to the Fed's creation after the 1907 panic, it really was, to have that lender of last resort, the ability to bring liquidity into the system at scale for duration, for any duration that's needed, to deal with those situations. And I do feel that that's exactly what you have a central bank for, and we're the only ones who can really do that in the speed and scale that we did. So yes, there's always issues about could the regulatory structure be better, lessons learned around that, but I do feel this is one of those situations that this is what what central banks are for, and we and our peers around the world moved in very quickly and effectively.
I completely agree with you on that. Let's turn to the international dimensions of the pandemic, and so the Fed re-implemented a very large foreign exchange swap program, and the take-up of it was really quite substantial. I think you got about close to $500 billion at the peak. Why was it done, and do you view it as being effective?
Right, and this was really following the playbook from the earlier crisis. We have permanent swap lines with some key central banks, but as we saw in March, we saw liquidity concerns not only in terms of the availability of dollars and the flow of liquidity in the United States, but around the world. And of course, the dollar is the reserve currency for the global financial system. You know, financial institutions and economies around the world count on dollar availability for their economies. And of course, that feeds back to our economy. So we very quickly recognized that these liquidity issues that we were seeing in the U.S. Treasury market and the you know, other money markets in the U.S. were happening around the world, and working with our you know, counterparts across the globe, quickly established swap lines with a number of central banks. They were utilized pretty strongly back in March and April. That's come down as you know, more concerns in markets around liquidity have receded. But I do think that they serve two very important purposes. One is making sure that that dollar liquidity, where the dollar is the currency of the world, was still flowing around the world, and we weren't seeing financial markets freeze up around that. And of course, the second is that assurance that, you know, market participants need, is that liquidity is not only here today, but it's going to be available next week or later today, next week, over coming months. And so I think that very strong immediate action, working with our colleagues around the world, both helped deal with the acute problem, but also raise confidence that would, you know, dollar liquidity would be available. And so, you know, we saw the best of both worlds. We saw the usage initially, like a lot of our facilities, because the situation, you know, was very stressed at the time. But then we've seen these facilities, including the swap lines, use come way down.
So having it as a backstop today, though, still helps support the market in an important way, right?
I'm sorry, I couldn't quite hear you, Bill.
Having that backstop today, though, that still provides quite a bit of support to the market, in your view.
Yeah, and I think that's true of everything we're doing, really. You know, whether you go through the various actions we've taken in the kind of the more traditional monetary policy realm, through our emergency lending facilities and our international liquidity facilities. All of them are, you know, serving right now important backstop functions, and also confidence. I mean, one thing we definitely heard in March loud and clear was, you know, I'm worried about today, but I'm also worried about the end of the month, the end of the quarter, the end of the year. And I think our actions have, you know, really taken some of that tail risk, if you will, out of people's thinking and planning, which is, you know, given all the challenges we have with the pandemic and the economic effects of that, I think that's has been helpful.
I know you can't speak for the FOMC, but you know, the Fed makes decisions about who gets swap lines and makes decisions about who doesn't. What's the thought process in terms of who should get swap lines and who shouldn't, and for what reason? How do you think about it?
Right, and you know, clearly this is a process that has gone on for many years. And you know, really it's the focus on what are the other central banks, these are swap lines with other central banks, but what are the other economies and financial systems that are most critical for the US economy? And it's really about the financial, you know, kind of connections and the role of the dollar. So it's, you know, we have a broad set of counterparties today, given the circumstances, but it is very much a focus on what are the economies and that are really critical for the US financial system, US economy, and obviously since we're so closely connected with the global financial system more broadly. So that's really where the focus is. Now, I will mention that one of the new facilities that we set up that complements the swap lines is our repo facility, with allowing other central banks to get dollar liquidity using their holdings of U.S. Treasuries through our operations at the New York Fed. And again, I think, you know, with the swap lines plus the repo facility, I think those together both have accomplished, and there's been very little usage, but what they've done is they've accomplished that liquidity is available to a broad set of countries, and again, that confidence that if there's another period of turmoil or market stress, that those facilities are available to be used if needed. So I think that's actually, it's a little bit of a kind of hidden, it's out in the public. We're very open about all this, but it's kind of a facility that doesn't get a lot of attention and it hasn't been used very much. But again, I think from a confidence and a backstop point of view, I think it has been an important part of our approach.
So presumably from the U.S.'s perspective, people can obtain dollar liquidity from the repo facility without actually having to sell their treasury securities. Because if they had to sell their treasury securities en masse, that would create another set of problems potentially for the Fed and U.S. Treasury.
Exactly, and that's the concern you get in periods like March or other periods where there's either a crisis or a panic, that people's concerns about the need for liquidity can cause them to sell into a market that's already stressed. And in March, as we all recall, even it seems like a long time ago, March, but there were these enormous one-way flows of financing moving out of certain riskier assets or unwinding of certain positions across the global financial system, and that was creating a lot of stress and illiquidity in that market. So one of the things that our facilities enable is that to kind of lessen the extra flow that might have been coming into those markets for people basically taking defensive positions or worried about things getting worse.
So if you look at the great financial crisis and then the pandemic, some would argue that the Fed has taken extraordinary actions, and this has greatly expanded its power and influence of the Federal Reserve. How do you view the evolution of the Fed as a global funding backstop and lender of last resort? Where should the Fed's role end, and where should the role of multilateral institutions like the IMF begin? I mean, there's some line there. Where do you think that should be drawn?
Well, of course, those lines also come up domestically too, obviously, in terms of monetary versus fiscal policy. And I do think where we have been very focused for the Federal Reserve, and I think other central banks as well, is really on the provision of liquidity and the flow of credit within their economies. And so clearly the international organizations, they have the ability to do more actions that kind of more like fiscal actions and support countries under stress, or have programs that kind of complement nicely what are, for us, basically liquidity, purely liquidity facilities. So that's been a big part of the conversation, both domestically but internationally, is making sure that the various authorities, whether governments or international organizations, they have their roles in terms of that are more fiscal in nature, and the central banks can do what we can using monetary policy and the liquidity tools. I will say that the level of cooperation and working together towards common goals, working, as using our own in our own jurisdictions under our own, kind of rules and laws, everybody's working towards the same goals. This is a global pandemic. We're all facing the same set of issues, and it's been very reassuring that across the globe we've seen very strong actions, again, moving us, I think, supporting the global financial system and economy at this time.
Are you worried, though, that not enough is being done from an international perspective, in terms of supporting economies that are sort of in weak condition? A lot of the emerging market economies, for example, are really facing liquidity crunches, capital inflows reverse and become capital outflows. What do you think should be done to mitigate some of the stress that we're seeing on those economies?
Well, I think that a couple things. I think that one of the things that we're doing, whether the Fed or other central banks, has actually mitigated some of those issues. I mean, from today, it's true that there are capital flows and economic consequences of a pandemic. That said, I think liquidity, the actions of the U.S. and other the Fed and other central banks has helped on global liquidity availability. I do obviously look at other institutions to play a very similarly, I guess the term of the day is muscular role in using their tools, and I see that happening. But I do think that again, what we've been able to actually minimize, I think, some of the kind of global liquidity issues. There's clearly other issues, economic issues that the countries are facing, and those I think other institutions can work on addressing. Domestically, I know you weren't asking directly there, but fiscal policy has been hugely important in the U.S. in this period. I mean, getting money into households' pockets, allowing families to keep putting food on their tables, pay the rent. The PPP and other efforts have been hugely helpful through the last several months to minimize some of the economic consequences of the pandemic. So again, I think when fiscal policy has its roles, monetary policy has its roles, and when we're working kind of in the same direction, I think that has been very beneficial.
Do you worry that people think that the Fed is more powerful than it actually is? In other words, that monetary policy can only do so much, liquidity can only do so much. It can't sort of repair balance sheets. It can't create income. Is there a risk of sort of disappointment if too much of the burden is put on the Federal Reserve?
Well, I think maybe there's a risk of people not understanding what we can do and what we are able to do, both legally, what can we do, and what we're able to do with the tools we have. Of course, we try to, and Chair Powell does a great job in his testimony and his speeches, and I think we all try to help people understand, this is the we can lend, not spend kind of mantra. That said, I feel that our job is to do the very best we can with our tools to address the situations we can, and look to others to do the same. And I think that's the way we're going to get the best outcome. So I'm not too worried about people looking at us and saying, well, oh, monetary policies can solve it all. I know I hear that sometimes, but I don't really think anyone really thinks that's the case. But what we can do, we've got to do forcefully and as effectively as possible.
In one sense, it seems like an easier crisis for the Fed in the sense that you're taking less criticism. What do you think is different between this and the great financial crisis in that respect?
Well, I think one thing is that, the financial crisis clearly had at its center financial institutions, banks, the mortgage finance industry. Obviously, a lot of people suffered terrible hardship, lost their homes and jobs. Then I think the sense of what caused it, who's to blame, remedies were often focused, I think, in the policy discussions, not at the Fed so much, but in the broader context around those kind of issues. Here, the pandemic, it's hitting us all. If using the terminology of economists, I'll use that. It's an exogenous shock that we're all dealing with, whether it's from the health side, economic side, or monetary policy side. And so I think that fact that it's really just an unanticipated, enormous global shock has made it easier to just write, all the different parts of government, all the parts of around the world, everyone focus on that and how to best address that. So I think in a way that's a bit simpler. I will say it has also had meant that we had to do things that we didn't do before, and had to come up with policy approaches and tools that weren't used before. And some of those would be around, the muni market or the corporate bond market, the scale and approach to dealing with the the disruptions in market functioning in the treasury market and the mortgage-backed securities market. So I think we've taken a very different approach in how to deal with those issues because they're different. But I think it's been very crystal clear, what the shock was, clear what the remedy was to deal with the situations as they evolved, and we've acted on that.
How do you respond to the criticism that the Fed's done all these things that have been very supportive of economic activity, but it's also worsened wealth distribution by driving up financial asset prices? How would you respond to that critique?
Well, personally, I think that the best thing we can do for income inequality and some of those issues is, get America back to work. We did see this in the 2017-18, 19 period, that as the unemployment rate, as the labor market got stronger, the unemployment rate got lower and lower. We saw huge benefits of that going to lower income families, lower unemployment rates, higher real wages, better economic opportunities. And we heard that loud and clear in our Fed Listens tours, both at the New York Fed, but we heard this across the country. A very strong labor market, very strong economy, low and stable inflation is part of that. It's important. It is really beneficial to families, especially lower income families. And so, when I think about, our monetary policy decisions, sure, they affect financial conditions. That is part of how it works. But really, our focus is on this maximum employment and eliminating the shortfalls from that. And I think that's to the extent the monetary policy is affecting inequality or issues like that, I think that's where we have our biggest positive effect, is helping families have stable, strong incomes, low unemployment. Now, of course, the broader context of inequality, whether income or wealth inequality, has been developing for decades. And I think it's separate from monetary policy issues, or these are issues that we need to address as a society, but it's really going to be, other approaches outside of monetary policy that I think are going to have the biggest impact in addressing this.
And we certainly wouldn't want to wreck the U.S. economy just to have a better and more even distribution of income and wealth. That would be a really great outcome. Let me ask you about the U.S. fiscal outlook. U.S. fiscal policy has been extraordinarily stimulative this year, and as a consequence, the budget deficit has grown significantly. I think the CBO today is supposed to publish a report that the debt to GDP ratio this year might climb above 100%. So how concerned are you about that fiscal trajectory, and what pressures does that potentially put on the Fed as we go down the road a few years and the Fed has to raise interest rates, debt service costs start to increase, and that makes the fiscal burden even more troublesome?
Well, first and foremost, I think that the fiscal actions, the enormous fiscal actions that you mentioned, have been absolutely essential to keep people able to pay their bills, stay in their homes, and help small businesses get through this extraordinarily challenging time. So I think this is why you want fiscal space. The reason you want good fiscal policy over the long term is so that when something like this happens, you're able to, the government's able to react and take the actions it's doing. So these don't concern me in terms of long-run fiscal health, because these are exactly what you need to do in situations like this, is to provide support in basically a disaster in terms of health and the economy. In terms of longer run health, I mean, we go back to this low interest rate environment. I mean, everyone likes to talk about the Fed in terms of interest rates, moving them up or down. But in fact, I think the big development over the past few decades is the secular decline in interest rates. And it's been noted by many around the world that even in the world of or a situation where debt to GDP is higher than historically, we're still seeing extremely strong demand for government securities, U.S. Treasury securities, and interest rates that are relatively low. So although I'm of course a believer in having fiscal discipline in the long run so that you can respond to these situations as needed, I'm not really concerned, given where we are today, about costs of government finance. And when you think about monetary policy, about when we'll eventually raise interest rates, that would on the margin affect government finance. But of course, that's always true in a cyclical sense, that interest rates going up or down has those effects. Right now, even the topic of raising interest rates is so far off in the future that I'm not going to focus on that right now.
Yeah, it's sort of a theoretical problem, not a practical one at this point. So compared to the great financial crisis, we haven't seen much in the way of like central bank coordination in terms of coordinated interest rate cuts like we saw in 2008. Should we make anything of that? The fact that there haven't been these sort of actions where all the central banks move at the same time. How do you feel like the coordination process is still working as well as it did then? How would you explain the differences now versus in 2007, 2008?
Yeah, I think the first of all, like I said, the cooperation, the discussions through the BIS, through personal discussions, through other international forums, like those have been very active and I think extremely constructive and positive. The pandemic hit us all around the same time. Obviously, hit China earlier. I recognize that, but we hit in Italy and some European countries very hard. Then it spilled over the U.S. And so we saw, as those events happened, very rapid actions by various authorities, and then we acted very rapidly starting in early March. So it's true that if you looked at it, like, did we do joint announcements? We didn't do many of those, but we were all acting very quickly using the tools that we have. ECB was a different situation in terms of where their monetary policy already was. We had already raised rates a number of times before, but interest rates were above zero. So we all took our policy toolkit, looked at the situation, and moved very aggressively. So it's true that we didn't make these joint announcements, but if you look at the timeline and you drew the timeline on a piece of paper, all of us were moving, I think, quickly and very much in lockstep in terms of what we were trying to achieve, using our own approaches as appropriate. So I really don't, I know at that time there was some commentary. So, well, why aren't you, why is it that this country is doing this on Monday and this one's on Wednesday or whatever it was? But we're all doing the right thing. It's just a matter of getting it done very quickly.
So in your view, all the boats were moving in the right direction together, even if there wasn't.
Everyone was rowing. We were rowing so fast that the thing was just to move quickly and get the right answer. And again, I think that's served us well.
how you assess central bank cooperation, coordination, relative to what we see in some other areas. I mean, other areas around the world, it seems like coordination and cooperation seems to be breaking down. Are things still solid in the central banking realm?
Well, yeah, absolutely. I mean, we do meet regularly, as you recall. I remember when we had a conversation when I was during my transition, how often you traveled to Basel for BIS meetings, and so clearly central bankers around the world are constantly discussing, sharing insights, and working really well together. As at the Fed, we're very proud and very focused that we're nonpartisan, non-political. We're focused on our goals given to us by Congress and doing our very best. And that's true of our colleagues around the world. And just, it is a bit of a group of technocrats, if you will, figuring out how do you best address the extremely challenging issues with the tools we have, and using creativity and trying to get the right answers as soon as possible.
Yeah, it's sort of shared purpose, shared problems. So that brings a lot of people together. Okay, I'm going to finish with a final question on a more personal note, John. You've been the president of 2 different Federal Reserve banks. Not many people can say that. How has the experience between being president of the San Francisco Fed and the New York Fed been the same, and how's it been different?
I think in the way that's been the same is the commitment of our employees to the mission. I mean, it's just so striking, no matter what people, whether working in cash processing, obviously our police officers who guard us in the facilities, the people who work in the various functions and areas of the bank. Yeah, you talk to people, we're here because of the public mission, the purpose. Everyone's feeling it right now. People working extraordinary hours. They're working from home. So I think that that's the common factor. I think this experience of the pandemic has, I feel a sense that if people, it's not just words, it's like what we get up in the morning to do. It's what we think about all the time. It's really how do we best carry out our public mission. So that's common. One thing that was different but has changed, and you'll find this I think a little amusing, is I had this reputation about dress for your day, casual attire. In New York, New York Fed, like New York can be, got to wear business attire. But we're way past that now with the pandemic. One of the people, the bank, said, was asked like, what was the big change for them and their work in the pandemic in a positive way. I mean, and they said, oh, well, I finally come around to realizing I can actually do my best work in my PJs or dress casually. So we've definitely seen change, and as people have worked these long hours from home in whatever situation, that it's the work that matters. And I'm just incredibly proud. I can't put in words how proud I am of my colleagues and what they've accomplished.
I had exactly the same reaction, John. I mean, people are committed to the mission and they're willing to do whatever it takes to achieve it, and they're also extraordinarily talented. So it's a great group to have the opportunity to lead. I felt I was blessed to have that opportunity, and I'm sure you feel the same way. So why don't we turn it to Emily Slater to take some questions for the audience. We've heard enough from me. Emily?
Yeah, sure. Thank you, John, and thank you, Bill. We have had several questions from the audience, a lot of questions on the role of fiscal policy, swap lines, kind of the pandemic playbook, and the outlook, but I think you've sufficiently addressed many of those. So I am going to first turn to Regina Schleiger, and I'll ask Regina to please introduce herself, tell us who you're affiliated with, and Regina, please make sure that the microphone icon is turned green and that you are not self-muted. Regina, would you go ahead and pose your question, please? Regina, could you see if you could unmute your microphone? All right, Regina is having some audio issues, so I'm just going to read her question for her. And Regina asks, do you intend to recalibrate the weighted average maturity of the Fed's Treasury portfolio in the near term?
That's getting to the specifics.
That's for sure.
This is, well, one of the things about being president of New York Fed is you go to the very broadest questions to the very specific questions. This is really a broader question about how will we, evolve our policy tools as we, move forward. And those are decisions that we haven't made. We've been really obviously focused earlier on in getting the policy actions that we took in March and April in those early months in place, and that we've been focused now on getting the new framework completed and the new framework statement out there, and that's been done. And so, of course, we're going to obviously turn our attention to how do we best use the tools that we do have to achieve our policy goals. And a lot of people are asking about, well, what tools are those? And I think, the ones I would focus on are really, obviously, the federal funds rate, which is, right now, near the lower bound. Forward guidance, communicating more clearly or more explicitly about how we're thinking about at which point would we adjust the federal funds rate in the future, thinking about how we're using our asset purchases that we're doing to better support the economic growth and achievement of our maximum employment and price stability goals. So those are the key tools that we learned a lot during the past decade. They were used quite a bit, and we learned a lot from that experience. So we'll have to think hard about how do we calibrate the use of those tools most effectively going forward in order to achieve the maximum employment price stability goals. A key thing that I'll just mention is that, those early months, there was just such extraordinary uncertainty about the economic outlook, what's happening globally in the financial markets. And so we acted aggressively and quickly to get our policies in place, and I think that was very beneficial. And we've been taking some time to, given that we've made those actions, strong actions already, to really try to understand better what's the likely trajectory for the economy. And again, once we made that diagnosis of where we think the economy is going and what tools are best used to achieve our goals, then obviously we'll discuss and make those decisions in the future.
Great, thanks, John. We're going to try this again, and we're going to try to go to Daniel Alpert this time. Daniel, if you could unmute your microphone and pose your question.
Can you hear me?
Yes, go ahead.
To what extent do you believe that the new framework is going to be any more successful in transmitting to good inflation, which is inflation in income, goods, and services, as opposed to the type of asset inflation and asset-related inflation that we've experienced pretty much for the last 10 years?
So the question was about the ability of the new framework. I want to make sure I heard the whole question. It was about the ability of the framework to help us achieve our consumer price inflation goals rather than affecting financial prices, right?
That's correct, yes.
Okay. Yeah, so I would say that that's our focus, is really to help try to anchor expectations, anchor inflation at 2%. We fell short of that for much of the past decade, and the goal is really to focus on we use the personal consumption expenditures price index as our measure, but that's a broad basket of consumer prices, and I do think that that's really. I think that's an achievable goal. Core inflation was running about 1.5% to 2% a lot of the time. So we're not talking about like we were missing our goal by an enormous amount. So, we just want to get it anchored right at that 2 instead of hovering somewhat below. So I do think that this is moving us in that direction. In terms of asset prices, I mean, there's a lot of factors that are affecting equity prices, bond prices, and beyond monetary policy. And I do believe that this low neutral interest rate, the secular decline in interest rates globally over the past few decades, is a big driver in relative asset prices, in the U.S. and around the world. We've seen, with very low returns to bonds and safe assets, we've seen, spread interest rates on a wide variety of assets come down. We've also seen, price to earnings, price to dividend ratios on stocks rise as you would expect in a very low rate environment. So I do think there are other factors affecting asset prices than the cyclical movements of monetary policy. The last thing I would say is looking at equity prices today. Of course, there's also the split between the various sectors and industries that have been either have been doing well during this period, like the tech companies, versus some of the medium-sized businesses that have not done as well.
Thanks, John. We're going to take another question here, and I'm going to go to another BWC member, Leonard Levy. Leonard, if you could please make sure you're not muted and pose your question.
Sure. My name is Leonard Levy. Can you hear me?
Yep.
Yes.
Okay. I'm chairman of American Industrial Acquisition Corporation, which is a private equity firm. My question for John Williams is the Federal Reserve or the Treasury concerned that banks hold at the present time significant positions of mortgages on office buildings, retail malls, hotels, restaurants, which are significantly impaired at this time? In the case of office buildings, we learned that people may not be going back to the office buildings in the same percentages as before, and as a consequence, we may be overbuilt. So what is the implication for the big banks? Thank you.
Yeah, that's obviously a question that, even more broadly, that we're very focused on since the pandemic, about how does it affect financial institutions, whether the largest banks or more broadly banks who make loans into these very sectors have been hit so hard. And you've identified a number of them, hospitality, leisure, but also mentioned the energy sector has hit hard by the decline in oil prices. So, from a bank supervision perspective, and I would really emphasize from the stress testing of the banks, there's a lot of effort at the Fed, but I would say even broader among the regulatory community of really understanding where the risks are in banks, whether large, medium, or small, in terms of their loan portfolios or their other exposures to these sectors, understanding, and obviously those banks have been, are expected to manage those risks and prepare for possible losses on some of those activities. So it's clearly an area of focus, especially when you think about our stress tests that are focused or looking specifically at the effects of the pandemic. What we've seen so far in the public results is the banking sector did come into this situation very strong in terms of capital, in terms of liquidity, and they continue to provide flow of credit and lending into the economy. But again, it's an area that we are very, very focused on, and making sure that our banking system stays strong and able to provide credit through the years of economic recovery.
Great, thanks. Let's go now to Russ Ives. Russell Ives, can you please make sure that your microphone is unmuted and please pose your question? Russ, can you unmute your microphone? Okay, Russ is having some audio issues as well, it sounds like, so I'll read his question as well. He says, given increased Treasury issuance to pay for COVID-19 response, what do you think of the idea for increasing dealer repo capacity through a cleared Treasury repo liquidity fund that expands netting options for balance sheet efficiency, a private standing repo facility that would mitigate the risk of repo market disruption and the need for Fed intervention?
Yeah, that's a really good question, and it's obviously something that's come up in thinking since going back to September, which really seems like a long time ago right now, where we saw disruptions in the repo market and obviously had to take very strong actions to restore liquidity and functioning in that market. And then again in March, we saw disruptions in these absolutely critical financial markets. So let me just give a quick comment about this idea that these are critical financial markets, because I think for a lot of people, repo market, some of these things we talk about are pretty obscure in terms of they don't interact with that directly. But when you think about the U.S. Treasury, the market for U.S. Treasury securities, which is the largest, deepest, most liquid market, repo market is very closely associated with that. These are the, if you will, the flow of money at the center of the global financial system. And when that flow gets interrupted, that just spills over to all the other credit flows, money markets, other funding flows in the financial system. So if these markets aren't flowing really well, then corporate bond markets, commercial paper markets, bank lending markets, things like that aren't going to work either. And that's why we're so focused on these kind of very, very core central markets and making sure they have adequate liquidity and functioning. Because with that, it spills over in a positive way, as we've seen in the last few months. So directly to the question, since September, there's been a lot of thinking, a lot of research by academics and practitioners thinking about how do we create a more stable, more robust, more resilient infrastructure around repo markets, around treasury market clearing. And I think those are important conversations to be having in the next few years, thinking about how do we improve and strengthen those absolutely critical infrastructures. So I know this is something that New York Fed and others will be actively engaged in. I'm not going to take a particular view on specific proposals at this time, because I think we're really going to learn a lot from the in-depth study of the data, understanding from market participants the various factors, and thinking through some of those issues. But that's definitely going to be will be a priority for many in the next few years. Again, I would go back to my comment I said to Bill earlier. I think that the pandemic shock, even with a some better infrastructure improvements there, which I think we need to think about, the pandemic shock was an enormous shock. And in a way, it's a shock that this is what a central bank is supposed to do, is to make sure that there's liquidity in these core markets. So, some people say, well, the Fed had to intervene, or because of some issues, but in fact, the Fed was doing exactly what it's supposed to do in those situations, just given the enormity of the shock and its effects on the financial system.
Thanks, John. Yeah, still lots of things to think about, lots of questions for the future. We're running out of time, so I just want to turn it back over to Bill and to John for any final thoughts here before we wrap things up.
John, any final thoughts?
No, this has been great. Great to see you. We're all seeing each other virtually now. It's a great conversation. I'm looking forward to seeing your future events that you're going to be holding. So.
Well, thank you very much, John, for participating today. Thank you for your service to the New York Fed. The New York Fed's in very good hands, and I think the Fed Reserve has been doing a great job through this pandemic. And hopefully we'll get a vaccine and we can actually see each other in person before too long. Thank you, John. Thank you, everyone.
Yeah, thanks everyone. So I think we'll go ahead and wrap up. Just to note that a recording of this event will be posted on our website. We did have to cap the audience actually, so I think some people didn't make it in that wanted to. So anybody who didn't make it in, please let them know that it will be posted on our website and they can watch it there at brettonwoods.org. So thanks again, John. Thanks, Bill. It's been an incredibly broad-ranging discussion, and I think very insightful for our members. So I very much appreciate your time, and on behalf of the entire Bretton Woods Committee, thank you.
Thank you.
Stay well.